Well, thanks for tuning into this video today. I'm Tom Perrone from New England Consulting Group, and I'm going to talk today about a buy and sell agreement, but in the context of an S corporation, because without a proper buy and sell agreement, your S corporation status could be in jeopardy if the agreement does not fulfill what it needs to fulfill to keep the S corporation eligible. And we're going to cover those particular elements and what you need to have in the buy and sell agreement to make sure that the stockholders keep their S corporation status and you don't lose it. And of course, during the course of the video, we'll also talk about how an S corporation works and basis, and it might help you out, and I think you'll get a lot out of it. So again, thanks for tuning in. So here we are, and we're going to cover the redemption of an S corporation. Why is it so important? It's critical to keep the special tax treatments of the S corporation because they are limited. There's particular rules about keeping the S status, and we're going to cover a couple of those rules. But you can see, based on the listing here, a couple of things. The reason why, first of all, you may want to keep that S corporation is if you notice here, 67% of the small companies, the last from 2013, are S corporations. And the redemption of an S corporation through a buy and sell agreement, it keeps its special needs. It builds the substantial net worth that you don't want to lose. You have your family's wealth tied up in the transfer of the business, and you have a buy and sell agreement that really guides you. It's like the railroad, the railroad guides, or the bridge guides, to guide you on how to redeem the company and to whom. And it spells out all of those particulars in a buy and sell agreement. And because of that, we do resolve any conflicts. As you can see, the risk of not having established buy-sell agreement, I circled a couple of things. The below market value, because you can establish the market value of the agreement. Uncertainty for the employees and the creditors, so they know the continuation of the business. And we have an agreement, and we have parties that are going to abide by that agreement. And we also, under 4, we're not selling to an ineligible entity, which affects the S corporation status. That's so important. And then, of course, the other ones are the obvious, from liquidity to the fact that the market could be weak, and you have parties in the company that are willing to buy it at a set price. Very important. Key points on the buy and sell and planning with an S corporation is, like I had mentioned before, ineligible entities. This is key because a lot of times inadvertently you could leave S corporation to an entity that is not eligible for that, and all of a sudden the S corporation loses its status, and because of that there's a 5-year waiting period, but also because stockholders will now face higher taxes, basically double taxation through a C corporation, which is why they went to S corporation, so they could have a pass-through. But just by not transferring it to the proper people through planning, you could lose that. So keep in mind the principles of any buy and sell is, of course, to avoid disposing of interest without the offering it to the first refusal, to your partners, to your other owners. The survivor owners of the entity buy the deceased owner's share. That's a contract. And you can establish a valuation. And that's important because in many cases, there's not a market out there. Only 10 to 20% of the companies sell, and only if 5% sell to the outside world. So these are important to have within. You know, when you do a buy and sell agreement with life insurance, it changes the game because the first three right here are the most expensive. A partner dies, the survivor is going to buy. Well, how are we funding it? You can borrow, that costs money. You can start a sink fund, but what happens if one of the partners dies before you save enough money? Plus, you have opportunity costs when you're earmarking money for the future. You can't use it to capitalize your company. And then, of course, cash, there's opportunity. That's assuming you have the cash. There's opportunity costs that you lose out on it because that money is not working as capital. So life insurance becomes a very affordable way of protecting the company by providing a death benefit tax-free to the surviving partners, to buy the interest from the estate. And when you take a look at the numbers, life insurance comes in extremely less expensive than the other methods, whether it's term insurance or some permanent form of insurance. So the S Corporation, a little bit about it. It's a limited liability. It's a pass-through versus a C Corporation, which is double taxed. So you can take advantage of the lower personal tax with the S Corporation. And you can also pass through deductible losses, which are normally in a C Corporation part of the corporate entity of taking the deductions versus personal. So it has a lot of advantages for a lot of people. So some of the requirements to maintain an S Corporation would be a domestic company, no more than 100 stockholders, basically individuals, decedent's estate, and the estate of individuals in bankruptcy, and certain trusts are eligible, okay? And this is important because especially if you're working with family trusts, that's very, very important. Can't be non-resident alien. Like I mentioned earlier, if, let's say, a partner's spouse was a non-resident alien, they obviously inherit their stock. They may cause the S Corporation to be ineligible. You can have one class of stock, but you can have non-voting also. So the taxation basis, the basis is a key word in S Corporation. Shareholders avoid taxes if the distributions don't exceed cost basis. Cost basis is always moving. It's up and down, always being calculated. But the higher the basis, the more money can be distributed out without taxes. So initial investment is part of the cost basis. Basis increases with taxable and non-taxable income, like a death benefit coming into the company. A partner dies. That increases the basis, especially with non-taxable income. It decreases when AAA accounts are distributions. So if money's coming out of the company, it lowers your basis. But it doesn't necessarily have to be taxable if you have a high basis. It just lowers the basis. Basis decreases with income in distributions the same year. And basis does decrease with losses and non-deductible expenses. So that's important to know when you're thinking of taxation. The key points of permanent life insurance is basically life insurance premiums are non-deductible expenditures. Term insurance does not decrease capital account value. Cash values can offset some costs. Split dollar is a loan, not a premium. That's important to know. Non-deductible expenses are charged to the capital account. Now, the capital account charges do not reduce the shareholders' basis until they're distributed. So here's a perfect example. Let's say it's a $10,000 premium, but the cash value is $8,000 increase. That $8,000 is part of the AAA account, the capital account. So in that particular year, there's only $2,000 that reduces the basis. Where if the premium was $4,000 term insurance, $4,000 would reduce the basis. So key points on the agreement. Beware of family attributions up to earnings and profits. Basically, when a stockholder dies and someone in the family, immediate family or parents own stock, it's just assumed that that's part of the whole deal, and it's called attribution, and certain things have to be done to avoid dividend distribution up to earnings and profits. Cross purchase and stock redemption you can use. You can apply a step-up cost basis and cross purchase. Remember, dividend treatment depends on the earnings and profits. And usually, S corporations would only have that if they, let's say, were a C corporation and converted into an S corporation. S corporation affects with no retained earnings, or what I meant by that was basically the attribution doesn't affect them if there aren't any retained earnings. So you got to recognize the tax if the shares were sold or exchanged, and that's basically a key area here, but it comes up to earnings and profits. So just be careful of attributions. You'll hear that word a lot when you talk about family companies with, let's say, family members that own stock, children, parents, things of that nature. So here is the stock redemption agreement. And basically, you've got a company that buys insurance on the owners, pays for it upon the owner's death. The proceeds go back to the company. They redeem the stock from the estate, and the sole survivor in this particular case is now the owner of the company. It does not help their cost basis. Connolly a year ago came out and basically said, okay, well, stock redemptions will increase the value of the company, but will not offset on the payment, which is very different than we all have been raised with over the years. But I must say that every case is still very different. It's not to say not to use a stock redemption, but again, there's some very innovative ways of using the cross purchases, either through LLCs, insurance LLC, whatever. So here we have the cross purchase, and that's become even more popular since Connolly. But I might add, since Connolly, there have been some pretty innovative ways of setting up cross purchase. I'd be happy to talk to anybody about it when time comes. But basically, how it works is let's say we have two owners, they would buy insurance on each other. The corporation would probably fund it through a split dollar or a bonus or whatever it might be. But upon the death of owner A, owner B would receive the proceeds tax-free, and then they would purchase through the agreement the equity interest of the decedent, and the surviving partner now would have an increase in basis for the future. So it has a lot of tax advantages to using a cross purchase. The problem with cross purchase has been in the past too many partners. If you had 4 people, you need 12 policies. You have transfer for value issues. But now with LLCs, insurance LLCs, we can mitigate quite a bit of that. So I hope this has helped you out. I'd be more than happy to speak to you about any cases that you are working with, and especially if it's an S corporation. And again, some of the benefit sides of an S corporation work very well. So thanks for taking the time. Well, there you have it. A lot of stuff on S corporations. I tried to make it as simple as possible. It's not necessarily the easiest topic to either explain or even understand sometimes, but it gives you a good handle on awareness. So if you do have a situation that you want to talk to me about, please give me a call. Use the contact information at the end of this video. Give me a call, send me an email. I'll be more than happy to help you out. And check out some of my other videos that I share on training, not only for business owners, but for advisors who are working with the business owner. So thanks again for taking the time. Thank you.